Works.
Is it recording?
Yeah.
We're so far the only people in this.
Is this the meeting with Andy? Oh, it goes participant. Andy entered the waiting room. Is he in here?
Yeah.
Okay, perfect. Hey,
Hey
Andy.
there.
Hey,
How are
how's
you?
it going?
And I just wanted, oh, we can't hear you.
Oh, I'm sorry.
Oh, now we can.
Okay. Which one of you is Zach?
I'm Zach.
Hey, Zach. How are you?
I'm good. And that's Harrison, who's
Nice.
also an executive of the club.
Nice to
Hey,
meet you.
Harrison. Nice to meet you too.
And just structure-wise, a thing I wanted to mention to you was just that we can roll it out to the club in the most efficient manner. Because last year there were just a few things popped up during the conference. We actually got questions from people that we explained who you are.
Oh, okay.
And then we're planning to record this, as I mentioned, to make available for you. But then also on our end, we're going to release it sort of as a speaker series where we give the recording to the club and then they can see what you talk about today. And then also the questions that they had for you, they've sent to us and we'll ask at the end.
Okay. So it's just going to be the two of you then?
Yeah. And then it'll be rolled out to a larger audience in a day or
Okay, sounds great.
And then I also had one more question too, just before we get going, was I know you mentioned that you wanted to share it with your audience and we want to do the same with ours, but would it also be okay if we made a club YouTube account and posted this on there?
Oh, please. However way you can market yourself with that content, I don't need the actual file.
Okay,
So that's even better. Go to a location that'll get you some exposure.
perfect. And then just let us know when you're ready to get going and we can kick this off.
Okay, I'm ready.
All right. So maybe just to start off and give a brief introduction to the club, let everybody know, how your career's been, what you've done, what your background is, and any other insights you can share on that. I think that'd be a really good introduction.
Sure, Harrison, no problem. Well, my name is Andy Constan. I've been in the investment business in one way or the other for about 34 years. I started my career at Salomon Brothers, which was an investment bank at the time, fairly famous. Liar's Poker was about that, that firm. And I joined after studying engineering at the University of Pennsylvania, and then got a job at Salomon Brothers in their corporate finance department. So the corporate finance department was taking advantage, levering up its efforts, because prior to 1980, the mid 80s, this was 1986, prior to 83, 84, spreadsheets didn't exist. And so when you were trying to put a deal together, it was literally back of the envelope calculations that were done by senior relationship people with their, not a legion of minions doing the crunching the numbers, but just a couple of guys talking about deals. And so the spreadsheet invention really changed the world in terms of the way investment banks worked. It was much more analytical and model dependent, and you could crunch a tremendous amount of numbers to really understand businesses and how businesses are comparable to other businesses. And I've told this story before, but when I started, I was an engineer, so I was probably more quantitative than my peers. That were about 60 of us came from various schools around the country to start at the same time. And I was probably one of the more quantitative ones in the top, certainly the top decile, but probably number one or two in terms of quantitative background. And so they gave me a PC that had a hard drive, which was not what they gave everybody else. At the time, you couldn't even store anything on your PC. It just had two floppy disks. And so I was honored to have a 10 megabyte, that's megabyte, not gigabyte, megabyte hard drive on my first machine. And so I started levering that by doing quantitative work, analyzing companies, analyzing various securities that companies had, and made an impact as a young person. And then the stock market crashed in 1987. And while it was not a good situation for the firm or for anybody on Wall Street, it turned out to be very fortuitous for me because Salomon decided to volunteer me for a 3-month project working on something called the Brady Commission, which was where President Reagan at the time got a bunch of Wall Streeters together to try to figure out what happened during the crash. And that really worked out for me. I got to see meet great people. I was very junior and everybody else sent very senior people. So I was able to get job offers after that. And I also met the person who ran equities at Salomon, and he hired me to start on the convertible bond trading desk. And so I did that for a number of years as a trader. And then through the next 6 or 7 years, I traded convertible bonds. And then I moved over to trade equity derivatives and did that for a number of years. Ultimately, I was running the global equity derivatives business for what then had become, after the mergers of Citigroup, Smith Barney, Nikko Securities, Salomon Brothers, County NatWest Australia, just a huge entity with a great equity derivatives franchise that I really helped, created and merged together all these various derivative businesses into one. And I did that for a number of years, ran that business, learned a lot about the global equity markets and obviously about derivatives. But I always, throughout my career, I always wanted to start a hedge fund. And so I did that in 2003 and was a founder of a relative value hedge fund trying to arbitrage the differences between various securities. My specialty was in equities. My partners were in fixed income and credit. And we grew fairly rapidly to about 3 billion in size in a few years, but then our partnership fractured. So I ended up trying to start another fund with half of the partnership. And we launched right during the financial crisis. So our launch, we weren't invested, so it wasn't like it was an investment return problem, but our launch was cursed by not being able to raise money as hedge funds globally all lost assets and had redemptions. So I spent the year of the financial crisis closing down that business and looking for what was next. And the thing that really interested me was macro investing, which is pure directional investing. And I'd spent a long time in individual equities throughout all my career, really. And I was suspicious of the edge that one can have trading individual stocks. I had seen years and years of insider trading scandals. That's certainly a way to trade stocks with an edge. It's illegal, but certainly was very popular. Not for me. And so I didn't really think that my world would revolve around that. And the fixed income markets are really very relative value oriented. So I was looking for something that could bring together something I had spent no time in, which is all of the numbers and data that make up a macro economy and how that affects classes of assets, not individual assets. So I joined Bridgewater Associates, which is a very large, the biggest hedge fund in the world, unbelievably successful. And by far the smartest group of people I had ever worked with before. And I spent a lot of time with the guys at Long-Term Capital before they left Salomon Brothers. I spent a fair amount of time personally talking to Warren Buffett when he was involved in Salomon Brothers, and Sandy Weil when they took over Salomon Brothers, Jamie Dimon. These guys at Bridgewater just are in a different league. And so I really valued that experience and worked there for a little over 3 years. But the culture, which was a fit for me in many ways, ultimately wasn't exactly what I needed or thought I needed. And so I moved on to Brevan Howard, which is a London and Geneva-based hedge fund, and they do macro as well, but in a very different style. And that was fascinating to watch Alan Howard trade macro. Ultimately, that led Alan helped me open my business, which is Damp Spring Advisors, which is a consultant to hedge funds to help them systematically assess the macro investment landscape and with discretionary techniques, identify great opportunities for alpha. And with that, I launched this hedge fund advisory business. And then surprisingly, and that works, that's fine. Then surprisingly, I started tweeting about a year ago. And I had, I've always been a little bit sort of at the edge for technology because it's always been and so, I stay current on any form of technology. And so I was always fascinated by social media. I did some projects with Alan where we would actually scrape social media for data for security selection and alpha. Done some stuff on AI, and so the whole area fascinated me. So I started tweeting, and my voice caught on. I had a few hundred followers a little over a year ago, and now I have 30,000. And a number of those followers have come to me and say, we like your tweets, but we'd really like to get more information about you and develop a personal relationship with you. And so I launched a subscription-based model for that. And that's been fun too. And, I'm just trying at this stage in my career, I've learned a lot in many deep silos. And also with the breadth that is fairly unique in the industry. So I really like to give that out to as many people as I can to help them understand that in a connected way. So that's been my career.
Yeah, you've definitely seen a lot of things in the industry over your years. And that leads us into a question that I have for you. Because famously, a wise man once said to learn from the mistakes of others. So if that's possible, I would love to do so, though I'm sure you didn't make a ton of mistakes. There are probably a few things along the way that could have gone differently.
Many mistakes, many, many mistakes. One thing I would say is there were times in my career where I tolerated difficult relationships with people because of as a means to an end, instead of being happy with my relationships with coworkers, bosses, subordinates, all those sort of thing. And tolerating that is very harmful to me, has been harmful to me personally. And so I would say if you find yourself in an intolerable situation with coworkers, you need to make a change because it can bleed you dry in terms of your year, your month, your day. And so try to find coworkers that you can learn from, that are smart and that have not only their best interest, but are more altruistic and have the team's best interest in mind. You can find these people in lots of situations where the team is not in their interest.
And then what I also wanted to ask about that was a culture question was you mentioned earlier that there were a lot of positives for you about the Bridgewater culture, but then there were some aspects that just for your individual personality weren't perfect. Could you elaborate a bit on that and maybe who it's for and who it's not for?
Yeah, no, Bridgewater is a very interesting place, and its culture is the type of culture I want to live in. Its implementation of that culture toward the end of my time there became, I guess what I would say is it became ponderous and bloated. And I like to describe it as this. Now, I came in when the firm was pretty big. It was, 1,500 employees when I left, and it still is around there. But it had grown, and it had grown a lot in the prior 5 or 6 years. And when I walked in, I was given a book that had a spiral book that was a published book, but clearly put together on a locally, not a real published book, of the principles that Ray had. And by the time I left, the principles was deployed on a iPad that everyone had to carry. And it describes, there's an old saying about messiahs and how messiahs tell, have the word. And I'm not saying Ray is a messiah by any stretch, but it's applicable. I'm not sure messiahs even exist, but if there is a messiah, what typically happens is he does unbelievably good work with a very small set of people who become his apostles. And those apostles have firsthand experience, hand to mouth to ear, hand to hand experience with the Messiah who gives the word. And then the apostles who've had that first experience move off to the priests to spread the word. And they do it well because they've had the firsthand experience and were chosen by the Messiah to represent them. But the priests start getting, you got to broaden out, and you have to take who you can get, who want to be priests. And the want to be a priest is itself questionable how that all works. So the priests write down the word, and they hand it to, I don't know what the next step down that's still part of the theocracy, but the next set of priests who are now have no experience with the Messiah, no experience with the apostles, and only have read the word. And those people don't implement it the way the Messiah did, or the apostles. And I think that was what was happening at Bridgewater. When I got there, I had tons of one-on-one spectacular interactions with Ray and the two other CIOs. And I always, because I was senior, I always had that good thing. But the rest of the culture started having, a lot of recently hired priests who were hired from McKinsey to be management consultants to spread the word of the culture they were looking for. And I just didn't think it worked. So I ended up and the way that manifested itself is at Bridgewater, you start with a business meeting to address a business issue that you were trying to do, whether it's a piece of research or an implementation of a trade or whatever it might be. And it's an hour meeting, and you spend the first 20 minutes dealing with the issue. And then because of this importance of the culture, that train of thought would get interrupted by the people that were there literally to observe the workers and try to help them with their cultural problems. And it would get interrupted, and the discussion would then be about, is the manager acting like he should? Is the subordinate acting within the principles? And that would be the conversation for the next 40 minutes. And so you'd have an hour meeting with 20 minutes getting done. And so that would make it very difficult to get things done. And Bridgewater also operates with a culture that's very goal-oriented. And so often you feel like I think they operate with their people at a marathon's distance, but at a sprinter's pace. And so that just burned me out, the combination of those things. But the culture itself is something that I need as a person. Not everyone does. I need it. And that is, my ideas need to be challenged. In any circumstance where I was the one with the ideas and nobody really challenged them, the results were poor. At Bridgewater, if I have an idea I need it to be challenged to make sure it's good. And they were very good at that. And I believe strongly in that. It's also very honest and open, but it's, that means it's also harsh. People don't like to be challenged. It's not a natural human instinct to accept challenge well. And so it's not for everyone, but it certainly was for me.
That's interesting. And I definitely even see on your Twitter conversations about your trades, if someone has a differing view than you and they comment it right beneath, you're happy to go back and forth, but from an open-minded perspective. Whereas even some very successful big name fund managers that aren't even on an anonymous account, they're under their name, might call some anonymous account a swear word and then block them because they said the trade idea sucks.
Yeah, I mean, there are people that troll for sport, but I still would like to understand why and get to, try to have them and me learn something from that interaction. If they're going to spend the time to interact, I'm going to spend the time to see if there's any juice there. And I have learned a ton. And it also, I think it also helps me to be more approachable. And so people with good, smart ideas feel like, hey, I can put this out there to Andy and I'm not going to get flamed. And so that's, an attraction, I think. That's just the way I just can't be any other way. That's the one thing I know about myself is I can't be any other way. So that's the way I am.
And going back to another thing you recently said about the principles and then how that became a thing that people were taking word by word that didn't really ever learn the principles directly from Ray or even one of Ray's next descendants, if you will. You definitely see how that could lead a culture astray pretty fast. Even thinking like, I've read his book, I thought it was great, but if during the Zoom, me having no clue about Ray other than what I've read in the book and online, if I was critiquing what you were saying on the Zoom, but purely by word for word definitions in that book, well, then I would be missing the forest for the trees.
Absolutely. And that's why when you're actually in a session about any topic with Ray and he decides to spend time figuring out what you're like as a person instead of dealing with the issue, it's as good or better than any psychiatric or psychological therapy session, yoga session, any session you might have had. It's I found it quite rewarding.
And then
But the rest of them, the set of other people, it was definitely hit or miss. Some great, but others just couldn't. It's very complicated.
well, and I even had a friend, I obviously won't mention his name because he chose to work elsewhere, but he interviewed with Bridgewater and he was offered a role. And he saw pretty early on before deciding to say yes or no that it just clearly wouldn't be a fit for his personality. And then
Sure.
he was laughing when he found out that their culture is so different than the other firms that they were actually watching his interviews to see everything they hard about him.
Of course, no, 100%. I mean, everything's filmed, everything's taped. It's you have no privacy. It's a very unique culture.
And then another question I have is, you had a
By the
very
way, one thing that's good about that, and it's very important that you understand this. They tell you that they're going to do that. You'd be surprised how many people do it anyway and just don't tell you. The best example about Bridgewater that I saw a million times at Salomon Brothers and other places is the conversations I would have with, somebody who was subordinate to me, who was managing another person about that person. While we could see them out on the floor through our glass office, and we were talking about them. If they ever heard what we said, they'd have a heart attack. It was about their future, about their career. Bridgewater, if you started a conversation about someone, you brought that person into the room. It was not acceptable to have talk behind people's backs. And you couldn't sugarcoat it either. You had to deal with the issue because that's the only way that person would improve. Now it's difficult for all three involved, but the fact that people, the fact that they tell you the way it's going to be versus basically lie and talk about you anyway at all the other firms is, it's refreshing to some, it's eerie to others.
And then a question that leads me towards that I think would be something that would be an interesting transition point arriving either at a Bridgewater or at a Brevan, when you're in a key role where you're expected to come up with good ideas and to share them in a timely fashion. Was there any adjustment period in feeling confident in yourself to be able to pitch your best ideas to a Ray Dalio or his core people when you just showed up there?
Sure. Again, most of the time in my career, I've had a competitive or at least a comparative advantage over the rest of the people that I've worked with, which led them to think of me more as a teacher. Whereas at Bridgewater, I definitely transitioned to a student. I knew very little about macro when I started. I knew a lot about what I knew. And so I was able to help in certain ways. And I could rest, but ego and confidence and more importantly, experiential learning is very frowned upon at Bridgewater. They'd rather have a good thinker than an experienced person. And the reason is it's quite simple. Experiential learning is you compare the current situation and problem that you face with prior experiences, and you say, okay, this is the way this is. And when I did this, I succeeded. And when I did this, I failed. And so I'm going to do this. And that's what experiential learning is. And the problem with that is that these are just cases, and your decision might actually have been the wrong one in both cases, but just because any decision may have a 60-40 probability, if you're making a good decision, you're picking the 60. If you're making a bad decision, you're picking a 40, but that doesn't mean that 40 doesn't happen. And so experiential learning generally leads to overconfidence in your experience and not adequate probing of the actual problem. And so, so coming in as a senior person, you definitely have to be egoless because you don't know shit about most of the stuff they're doing. So, that worked for me. I was there to learn.
Did you have any problems when you're in such a unique culture that you took so seriously about that maybe carrying over a little bit too much into your personal life with friends or family members?
No, it was fine. Others, again, I'm just very much an open book. And so others had a different reaction.
And then another thing I wanted to touch on was over your varied career, you mentioned that you started 2 successful hedge funds. And I know that a lot of our viewers want to be fund managers someday. So looking back on that, what were the most important things that you did right? What were the most important things you did wrong? And then just in general, what are the most important things if you want to be a successful hedge fund manager at your own shop?
Sure. So I have a couple of points to make on that. In terms of what I did wrong, that by far was choose bad partners. People who we all went out on a lifeboat and it got ugly. And so, looking back, that was my mistake. Potentially fairly obvious mistake, look in rearview mirror. But yeah, that was the big mistake I made in my fund. And what I did right, like to think there were a number of things I did right. The biggest thing I think I did right was I had been a sell-side trader, which is a market maker. We did a lot of proprietary trading, but I worked for a big bank and my clients were hedge funds and other investors. And our job was to trade as often as possible because we collected the bid offer spread, and our sales team was trying to get clients to trade all the time. And the biggest mistake you can make as a hedge fund manager is trading too much because you're paying bid offer spread, and your job is to minimize that in the way you operate. So I did a good job making that transition. I think that was very important. But let's step back a little bit, which is This is more an overall career risk sort of thing. When you work in finance and you take a job at a big bank, there's a fair chance you're going to have a very comfortable life if you stay at that firm forever. And there's going to be a period of time when you're starting a family, you may have kids, have moved into a bigger place, you're starting to enjoy the luxuries of working at in a business that pays a fair amount. And they've got you at that point. And so prior to that, if your goal is to become a fund manager, you have to exit before you are trapped in the niceties of a senior investment bank executive, or you have to suck that firm dry in terms of learning, so that you then have reached a point in your career where you can say, I don't care if I earn another penny, I'm going to start something I love. That's where the way I took it, but there's definitely another approach. When you're young, you've got all the world in your future in terms of your earnings power. And that's when you should take, in my view, that's one of two times you can take career risk. But you have to be very willing to make a lot of mistakes. And the key thing for that, in terms of leaving early, so you have this sort of apprenticeship, producer, manager. In that apprenticeship, it's good to have a Wall Street apprenticeship. It's good to have a big firm apprenticeship, whether you're on the sell side or the buy side, where you really are just doing a lot of hard work and learning a lot. But when you make the next step, that's when they trap you. And it's really important to get a good apprenticeship and then make a judgment of whether you want to go 10 years longer at a firm or firms to really get the most learning you can do before you head out on your own. And so if you do it as a young person, you're not fully ready. And so the most important, but you're ready to leave a big firm and start a small thing. It's really important that you choose you won't be able to run a fund yourself. So it's really important that you choose your mentor well, because that's going to be your only place that you're able to learn in a small enterprise.
That's a great answer. And then another thing relating to the two funds you had, obviously you had a strong background, which I'd imagine was a part of you being able to raise funds and market yourself.
Sure.
But there were lots of people that had that same background that started a fund and did not get up to 3 billion in AUM. So what do you think the key is once you have the experience, you have the talent, and you start to actually raise enough capital or not, aside from returns?
Yeah, I mean, in the end, to me, the hedge fund money raising activity is having a strategy that is well described and easy to understand, but also something where there really is a demonstrable opportunity. Long short equity, for instance, I don't know how anybody raises money doing that, partly because of the thing I said at the beginning, but a million people do that. I just don't get how there can be an edge. In our case, we were doing some fairly interesting relative value strategies in a different way than at the time was fairly innovative. And so that was a good pitch. But if you're going to start big enough to succeed quick, which we were all very interested, there is a pedigree issue. And so having a pedigree is important. Choosing your providers, legal, back office, risk management providers, service providers, prime brokerage, being to have connections to get the best of those things and be afford to pay for them is helpful. but ultimately it's returns. And so we grew when we started demonstrating the types of returns that we told people about. And there are people, and money can be very fleeting in terms of returns. You underperform, the money goes, you outperform, the money comes. And then there are firms that do other things to try to retain money. And Bridgewater was a great case where they have 300 customer service people whose sole job is to help the client with any problem they have, either with their investment at Bridgewater or more generally their investment process. And as being a trusted advisor was presumably makes the hedge fund money stick, even if the returns suffer or underperform. And so you have to make some judgment on how you're going to retain money when you're down, because you're going to be down.
And then another thing I'm curious about, at your funds, could you obviously you don't have to share anything proprietary, but could you go in a little bit more depth onto what your strategies revolved around in terms of relative volatility and arbitrage?
Yeah, sure. So I did, I'm not going to count them yet. I did volatility arbitrage. My favorite trade at the time was long Nikkei volatility and short S&P volatility. That was a very good trade that worked out for a long time for me. I did capital structure arbitrage at both the individual stock level and the broad market level. So for instance, buying a typical capital structure arbitrage trade would be buying corporate debt and hedging it with equity options. So that would be a good example. Now, you could do that at the index level too, with CDX and S&P. So that was a relative value trade. Merger arbitrage, which is betting on a deal closing that's been announced. We did some of that. Typically when there was some form of derivative associated with it, not just generally where you were sort of receiving beta. Convertible bond arbitrage, long convertibles or short convertibles and hedging their component parts. What else did I do? Oh, I even did, an interesting trade that still is interesting to me and I look at all the time now, which is taking an oil company or a basket of oil stocks typically that were really pure producers. They essentially were equities of companies who own oil in the ground, and saying, how would you model that? And, we modeled it by saying, well, it's, a decades long stream of taking the oil out of the ground and selling it at the spot price. And so we then I developed a relationship between long dated futures on oil and individual equities or baskets of individual oil equities. And of course, there's some market risk too, because they are stocks and they're part of a stock market. And so, coming up with some sort of relationship between those three components, you could then arbitrage between oil and oil stocks and the S&P. So I played with that too. So did lots of those types of trades. All were long one thing, short another thing. And at some level, depended on the proper workings of the financial system, such that if the relationship went against me, somebody, if not me, would have capital to lever up and bail me out of that trade. And obviously in 2008, now I had closed, never reopened our fund, but in 2008, a lot of those types of relationships broke down. And in 2020, in May, April, a lot of those relationships broke down.
And
So
as far as the merger arbitrage stuff that you guys did you look at the term structure at all and see if there was any tell there? Because I know some people have had success looking for the volatility smile and then cooking that into their analysis.
Yeah, I mean, that's sort of, so there's a bunch of things that over time have become table stakes for investing. That's a classic one. Back when I was doing merger arb and using options. Nobody was doing merger arb with options. Everyone was just buying the stocks. And yeah, you could do things like, the deal's going to close on this date. Why would you ever want to have premium past that date? Now you can't do that.
And then what types of strategies now are you most excited about that you wish were around or were this lucrative back when you had your funds?
Gosh, so now all I do is macro. I don't do relative value trading at all. And macro is very hard, and alpha in macro is hard to find. And so I would classify that as the way I would say it now is, well, certainly if anybody who knows even 80% of what there is to know now, who was back to the future, back to 1985, would, not knowing what was coming, but back then with the same quality of thinking, would dominate. It's not an issue, but markets constantly evolve in that way. And for me, the thing that I find interesting now is linking all of the things I know together to come up with a strategy. And I typically, I use options as my primary risk management tool for my macro views, but mostly what I care about is trying to come up with linkages that people don't understand well. And lately, the last couple of years, because of the enormous QE and then soon to be enormous QT, those factors, people still are not, people I interact with who are top of the craft still don't understand things. Or I could be wrong too, but I don't think so in this case.
From a macro perspective, as somebody who's been in the industry through multiple crises, what's your thoughts on the current environment and where people can look for alpha?
Sure. So, the source of alpha is being better at identifying where prices are going to be than somebody else. So anybody who sells you something that you think is going up or buys something from you that thinks you're going down is technically paying you the alpha. And they have negative alpha and you have positive alpha, and it's zero sum. And so by and large, it's impossible to get. Except there are some reliable sources of alpha where the provider of alpha to investors is has non-P&L related issues, potentially very economic related issues. And so the central banks are a great example of that. The fiscal policy makers are a great example of that. And so understanding how they're going to behave and what they can do, what tools they have, what they're willing to do, what they're able to do is has been a great source of alpha over the last few years.
And I've definitely seen just in my own journey of coming up with strategies that the best and most repeatable ones with the most definable sources of edge are the ones where you're taking advantage of someone that is doing something for a very obvious and predictable reason again and again and again and again, and you get to trade against them.
Right. And the classic trade is we saw the December before last when Tesla was added to the S&P 500. Everyone knew it was coming. Everyone knew it was coming. It was announced the day it was going to happen. But the order flow was so enormous that you could buy 15 minutes before the close and sell 90 points higher on the close and cover 60 points lower the next morning. And that's just because there was and I like to describe what that is. Anytime where a large price inelastic trade is coming to market, there's a fair chance there's some alpha. But, it is a game theory problem because you have to judge whether there's adequate capital to arbitrage that away and take that excess return out. And so that depends on factors that, change through time where there are more people trying to seize on that same opportunity and it disappears.
Do you have a question?
Well, we kind of went into alpha, but we didn't really talk about the current environment. So from a macro, with inflation and
Sure, let me come to that. Yeah. It's a very interesting time, obviously. I've never seen an economy shut down, global economy shut down for in, 3 weeks or 2 weeks. And I think we'll all remember that experience. It's a phenomenally interesting experience, and how it impacted companies like the big box stores that were allowed to stay open, and grocery stores that were allowed to stay open, but other companies and businesses weren't. There was a lot of choosing that happened by, at some level, the government. And so that's an interesting lesson. But a sudden stop of the economy when it restarts is going to be inflationary. I don't know how you guys have been, but my basic picture is, if you like to go out to dinner 2 days a week, say, prior to COVID, there's a very good chance you're going out 3 times a week when you got out of lockdown. But it's unlikely that you're going to go out 3 times a week for the rest of your life. You're probably going to go back to your old habits of 2 times a week. For one, ultimately, you're not going to be able to afford to live that particular consumptive lifestyle, because your stimulus checks and the fact that you were able to still have a living even when you were staying at home and saving all the costs or whatever it might be, people had good balance sheets and were able to consume and are consuming. And so that's been inflationary. There are lots of, my personal view is that inflation was largely a fiscal led demand creation versus a monetary inflation, where the Fed doing QE was the cause of inflation. My basic picture on that is, well, there wasn't really a large inflationary impulse after the great financial crisis, mostly because the government didn't spend, but the Fed did buy securities. And so what we saw then and what we're seeing now is the Fed does generate asset price inflation by buying assets, but doesn't really generate goods inflation except by the mechanism of the wealth effect, where these assets go up, so people feel more wealthy, and they either borrow against that wealth or consume some of that wealth. That can be a weak inflationary generator. But you put money literally into people's bank accounts just out of the blue, people are going to spend that money. Some are going to save, and lots did. And you saw that effect on certain stocks and assets as we, gambled at home. Or many did, I guess.
A lot of people in my demographic definitely were at the front of that crowd.
Yeah, sure.
0 day to expiry call options, 5% out, and hoping for a lotto ticket.
Yeah, 100%. That was obviously happened. But the asset inflation is real. And so you could expect QT to generate asset deflation. And so it'll be interesting to see, and you have to track the details very carefully to see how the QT is going to be handled, how much it is, how fast it is, what things are sold to finance the Treasury roll-off, the Fed roll-off. But the big thing is past. The big fiscal impulse is past. People still have a lot of cash lying around. Some actually, there are enough. If you just look at the crypto total market cap, that went from essentially 0 to, I don't know, a few $1 trillion, $7 trillion, whatever it is, that's real money that people can spend. And that may have been pushed by people putting money in people's pockets, and they didn't consume, they just put it into, crypto or whatever it might be. So it's an interesting circumstance, but that fiscal impulse is, at least in the United States, is dead. I don't think there's any chance in the I have no idea how the midterms are going to work, but I think there's extremely low odds that the Democrats hold the House and have enough senators that they can override Manchin and actually force their fiscal policy. And so what we're going to have is we could have exactly what we could have, or we could without the Senate, without those Senate seats, there's no chance that either party is going to be able to dictate. Well, the presidency will be the presidency, the Congress will be whatever it is, it'll be gridlock. And so only if there's a real crisis, I don't know what that crisis would be, but let's say there's another crisis. At that point, the fiscal impulse might go up again, but it's not coming. And so your real inflation is now generated by people's wages rising. Now they're not rising that hot quickly. They're not keeping up with inflation, which means real wages, as they call them, are lagging other measures. And so the other way people can continue to spend after their stimmy checks ran out is by borrowing, levering themselves up. Now, banks are very willing to lend right now, and so that is a possibility. But for how long will people take on additional debt to consume is really what you have to ask yourself if you think inflation can persist. So then there's the supply chain issues. You know, when you have this, when people don't come back to work, supply, and also you have wars, supply, and you have literally just boats that can't make it across, get stacked up at the ports now that we're reopened. You're going to have supply shortages. Those will get resolved. How soon, we don't know. But demand destruction isn't going to fix them. Just the fact that people aren't, they can't get it. So you can't cut demand and somehow prices disappear. There's no way to get the good. You have to pay for it if the limited quantity there exists.
And
so,
apologies for putting you on the spot here, but I think this could be an interesting one for a lot of our viewers.
Sure.
I believe that you're bullish on the market during a time there's a lot of thinkers that are saying, oh, Andy's crazy, it's going to crash, it's going to be the biggest black swan ever seen. I've seen some of those interactions. So yeah, I think it would be of immense value to our crowd if you could kind of break down the reasons why you formulate a bullish view. And then also it would be great, though no one knows for sure what the future holds, if you could tell us what time frame your thesis should hold up for if it comes to fruition.
Right. So let's roll it back a little bit. So I became bullish. I was bearish equities in print in my damp spring report in January of 2020. I had no idea that COVID was coming. There were just other fundamentals that didn't make sense to me, that macroeconomic data that didn't make sense to me, and said I should be short. And I got lucky. The world didn't, but my short position did. But on April 6th, having lived through the financial crisis and being absolutely astounded by the size and scope of both QE and the fiscal spend that was announced to deal with COVID, I became bullish and really haven't turned back since. However, December 15th this year at the Fed meeting, Jay Powell had a press conference, and in that press conference, he said, we're looking at the balance sheet. And I heard that, and I immediately related that to quantitative tightening, which is unwinding of the balance sheet, and tweeted that this, I think first out there, tweeted that this was a game changer. The markets continued to rally, and by December 29th, I wrote about the impact of QT on financial assets and called for January to be the all-time high in the stock market, and calling for bond yields as the stock market sold off to rally to fall, and then ultimately to go back out. And it was all based on quantitative tightening, which is going to result in the Fed's balance sheet essentially getting financed and being the securities used to finance it crowding out other assets as they get placed. And on January 4th, the minutes came out and everyone said, oh my God, this is really happening. And we sold off till mid-February. And I traded it badly in terms of my advice to myself, my investors, but also on Twitter and with my clients, and said that it was overdone a couple of times too early. But on February 14th, I looked at the full range of assets and realized that in all other tightening cycles, going back to 1994, the portfolio of assets, not just stocks, but stocks, bonds, gold, commodities, had discounted so much that the full tightening had happened already. And we hadn't even started tightening. QT hadn't actually happened. And so I became bullish, and very bullish assets and very bullish stocks. And since then, even though everything that we had expected to happen, Fed hikes, quantitative tightening coming, seems extremely hawkish and bad for assets. By February 14th, everyone had already discounted the worst outcomes. And then the war happens.
Yeah.
And that created another leg down and another time when assets had cheapened. They had popped and then they cheapened. And so where are we now leading into quantitative tightening in June? We're still in what had happened after the war began, and because of because of the Fed's hawkishness, extreme hawkishness, the narrative had come to the Fed is going to cause a recession. Bond yields were at 10-year bond yields were at 170. Stocks were at their lows. The Fed is going to cause a recession. And of course, the Fed could cause a recession, but the probability as priced into bonds at highs and stocks at lows had gotten to an extreme value. And so I sold my bonds, levered up my stock positions. And I think what's happened over the course of the last few weeks, the last week, is that narrative is now not really accepted anymore. Certainly, there are a lot of people out there who rightly think we're going to go into a recession, but sentiment is measured in so many different ways, from Twitter polls to Bank of America, Merrill Lynch investor surveys to anything you can think of, is extremely bearish where a recession is expected. And it just may not. And so that's what's fueling my bullishness. One last thing is a technical matter. GDP growth by most estimates is expected to be around 2.25% for the year. There are people higher, there are people lower, but it's around there. But inflation, nominal inflation, inflation is around 6%, which means that nominal GDP, which is what stocks earn, is going to be around 8%. And so revenue growth is going to be 8% this year. That's extraordinarily high. When you have non-inflationary environments where inflation is 1% and GDP growth is trend at 2%, revenues are going to only grow at 3%. Now they're growing at 8%. And certainly input costs are going up, but companies have what are called fixed costs and variable costs. Essentially, they have what's called operating leverage, and their fixed costs aren't going anywhere, but the rest of their costs, they're going up, and wages are going up, input costs are going up, but that creates leverage. And so I think while the consensus still remains that I think strongly that we're going to have a recession, and this year's earnings are going to struggle to beat last year's earnings, my view for now is that that's wrong, and that we're going to see continued improvement in the outlook for growth and earnings over the course of the next month and a half. And then the Fed meets in May. And I don't want to get super technical on this, so I've talked enough, but there's a couple of interesting things about the way QT is working that will be revealed by a combination of the Treasury, who will tell us how they're issuing bonds to finance the government, and the Fed in terms of how much they're planning on selling of their balance sheet or letting roll off of their balance sheet. That combination of things could cause me to go from bullish to bearish just on that data. And so I'm looking to that particular date as the pivot. So bullish now, could be either way come May.
So you're keeping people on their toes. They have to stay tuned.
No, I'm on my toes. Listen, I'm on my toes. I don't know. I have to see what happens.
Yeah. In this environment, that's the only objective way to be. So that's why I laugh when there's either these people that are like doomers that for 20 years have made a career selling gold products, saying that the end of the world is right around your doorstep corner. And then other people that are on CNBC with their dress shirt sleeves rolled up, yelling buy, 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 no matter what. So I respect that you're able to actually objectively make up your mind based on the facts at the given time.
Right. And the trick and why there may be alpha is because, as much as I've explained it on my clients and the world of Twitter and podcasts, it's conceptually difficult to get the message I'm giving. And so I think there's a fair chance that when it actually comes out, that the actual information in May comes out, it'll be misinterpreted and there'll be opportunity to pivot. That you don't have to predict the event, you can actually wait till the event. Sometimes you have to actually predict the event. In this case, I think you can just see the event.
A last question I want to ask you before we wrap up, given that we are a derivatives club, though we're interested in all sorts of types of investing, would be you structure your macro views through derivatives, limiting the downside, but then trying to catch as much of the upside as possible in the best way. So without getting too deep in the weeds, what would your advice be on how to limit downside and capture upside through the use of derivatives for whatever your view is on what's going to happen in the markets?
Right. So I guess the first thing is you can't just buy options. That obviously limits your exposure to what you paid. Because if you do, what you're really doing is buying theta and paying away time value through time. And that will bleed you dry because options tend to be rich. So I can't advocate to anyone that they use a strategy of long options. So one way to mitigate that is to use option spreads, buy a call, sell a call. That's tricky, but that's a way of mitigating it. The other is to express portfolios using both long spreads, which have known downside and known upside, and short spreads, meaning writing an at-the-money put when you think something's going up, writing an at-the-money put, and buying an out-of-the-money put to protect you in case you're wrong. And that can generate positive credit income from your option sale. Typically, those are unpopular because the selling of option spreads generally results in so I like to think of favorites and long odd bets. Buying option spreads gives you a 3-to-1 payoff. So you put down 1, you get 3. Selling option spreads tends to give you a 1-to-3 payoff. So you put down 1, you're not going to ever make a lot of money and you could lose 3. You have to balance those things so that you don't have a portfolio that bleeds theta. And so I guess that would be the most simple thing to give you.
And then you have
to not just a vol. Yeah. So the levels of vol. So if you come to a new trade, you have a portfolio that's roughly balanced for theta, and you come to a new trade, whether you choose to express it as a long vega trade in which you're paying theta, or a short vega trade, which you're receiving theta, may depend on your outlook for vol. And so for me, it's this is how I do it. Having an experience with direction, I then want to optimize for the vol I think is occurring as a secondary goal, but absolutely part of the process.
Thank you for your time today. We really enjoyed it, and our club members will really enjoy it when we release this to them. And I hope that we could have further conversations down the road, because it's really helped the way that I view investing in the markets in a big way.
Sure. Anytime.
Yeah, everything.
Pleasure, Harrison. Pleasure.
Really
Zach,
valuable
I appreciate it.
there.
And
All right.
wish you all the best, and thank you for speaking.
Sure. Good luck.
Thank you.
Sure. See you guys.
Yep. Have a good one.